So where we had left off was talking about different types of investments, and I started to explain a little bit about the fact that you really, from a strategy perspective, real estate should probably be part of your portfolio because real estate in a normal market. I'm not saying Phoenix or South Miami or something like that. There are some markets that are known to be very speculative, and those you would probably want to treat with a little more caution. I'm not saying you wouldn't want to invest in them, but you probably wouldn't want to, leverage yourself. You wouldn't want to. When we talk about leverage, we talk about borrowing money for investments, right? And borrowing money on margin, if you're doing it in the stock market. So to do that in a really, crazy market, I don't know if I told you about these two doctors down in Pensacola Beach. Okay, so what they did, Pensacola at the time was blowing up. The markets, all the markets were blown up. 2006, you can do no wrong. Real estate is always going to go up. And so they bought big. They were these Atlanta doctors. They bought the whole penthouse floor thing. I think it was 2.1 million bucks. And, they stood to make a fortune because they're using borrowed money. So they're going to, they're probably in it for maybe 20% down, 400,000 or something like that. And they're controlling this asset that's going up at that time, 8-10% per year, which is a lot when you're, that's a tremendous amount of money that they were generating. And then everything went south. And their options were quite limited. What they ended up doing was they ended up selling that whole thing for around, I think it was 210,000. It really was that bad, where it just almost went to nothing because there was no market. Nobody else could buy that. And so, something, like I say, something you're trying to sell is only what somebody else is willing to give you for it. And there wasn't any market makers in there. There were, condos and stuff in Miami that were also, incredibly discounted due to the whole collapse. And so these people sell, and now they're stuck. You still have that mortgage for, 2.1 million bucks, but you're done. I mean, your life in terms of financially is kind of over. So that's a huge, and hopefully, lightning won't strike twice. But again, they probably should have been a lot more cautious. And if that happened to somebody like you or I or whatever, you go, this is going to suck, but I'm going to declare bankruptcy and go hide under a rock for 7 years. If you're both doctors, the courts, they don't have to grant you bankruptcy. They'll give you like the wage earner plan, and you're basically, an indentured servant or whatever. You're working off that debt. They won't discharge that if they know, as these two people did, they both were high income individuals. They have the ability to pay that. So that's something you wouldn't want to do. But for normal real estate, man, if it even goes flat or down just a tad, it's big news because that typically does not happen. So real estate is a very cautious play in terms of investing, and that principle, bless you, that principle in terms of being able to use borrowed money and borrow on margin. So again, let's look at a better example. Let's say, another market like say here in Alaska, maybe a couple percent, maybe on a good year, 3% inflation. A lot of that's kind of driven by the military people coming and going and trying to recover their 6% that they paid in the commission. But anyway, it tends to have an inflationary effect on housing markets. But even so, the market here doesn't go up that much. So it wouldn't be, what you probably consider competitive with a typical stock investment because the market, on average, across the board, and this is a gross generalization, but it's roughly true that it goes up about 10% per year since that's going back over 100 years. So why would you invest in real estate? Well, you probably would not want to use borrowed money in the market, borrowing on margin, but in the real estate market, it's completely normal. So let's say, it's going to be an investment. They're not going to let you get in there for nothing down. You're not an owner occupier. you're going to be doing it as an investor, so you're going to probably have to put 20 or 30% down. So if it's a $300,000 property, you got to put down 60 grand. But on that 60 grand, if let's say the market goes up by 2%, so what's 2% of 300,000? Quickly. $6,000. And you were using 60,000 to control it. Oh, look. So $60,000 and you earn $6,000 on it. You got 10%, right? And you experience very little risk. Now, there's a couple more moving parts. You did pay interest on that money, so that may knock you out of the water. But anyway, you can see where there's certain things in real estate where using borrowed money might get you ahead. Now, the problem if you try to use borrowed money on stock purchases, number one, it's not, it's not a good idea because stock prices can be volatile. They can go up and down. If prices go, if it goes back by 10, 15%, they just call that a correction. Nobody even gets too wrapped up about it. But if you're buying stock on margin, you're going to put down a certain percentage. Let's say, they'll allow you to margin, like you want to buy $5,000 or $10,000 worth of stock. They may let you do that for $5,000. You'll get, twice the amount of stock. So you're paying basically cash for one half, and the other half you're using borrowed money. But the problem is your underlying collateral, your security on that loan is the stock. So let's say that this stock was worth $10,000 because that's what you just bought it for. You bought all $10,000. So that meant you needed $5,000 worth of collateral. Well, let's say the stock price drops by like 20%. So now your stock is worth $8,000. And that money you had for collateral, that amount you had in stock, is only worth $4,000. They're going to give you a margin call. They're going to call you, the brokerage is going to call and say, hey, the terms of the game are you need 50%. So you need to come up with another grand here to cover this, to cover the margin, or we're going to sell. So you're like, well, God, I don't want to sell at the bottom. So I, scramble, get another $1,000 together. I meet the margin. If the stock continues to slide, I keep getting margin calls. And if the worst case, the company goes out of business, at some point they're going to sell that stock if you can't cover the margin and you're locked out. So that is not a good place to be. So for again, any kind of buying stock on margin using borrowed money kind of stuff, that's kind of beyond the scope of what we would typically do in personal finance and call it investing. That is speculation, pretty much straight up. That's an imprudent way to go. But real estate, it's the way it goes. So I talked a little about this way, 2 ways to make money on stocks. Dividends. So dividends, what happens is the company makes a profit, and they're a big established company. They don't need to build a new building or do any of that kind of stuff. So as an enticement to, keep you as a loyal stockholder, they will return a portion of that profit to you in forms of a dividend. And like I say, I never get dividends because I never invest in those kind of companies. I typically invest in growth companies which use their money to build buildings and, do R&D and do stuff like that. And then so that's what I'm after, is that second part, the price appreciation. I'm looking to buy something like a good one I got right now is OKDT or whatever, OKT, I think it is, Oak Data or Oak Data. And we'll look at it in a minute, but it's going through the roof, and it's all price appreciation, doing quite well. So that's a growth stock, and they don't pay a dividend. And the investors who invest in that type of company don't expect a dividend. Now, income stocks, those are the people who expect a dividend. But, I hate to say it, but it's a fine line. I mean, some of these companies, the Kodaks and the Xeroxes and the IBMs and the GMs, maybe they should have been doing a little bit more investing and be a little bit more aggressive and and get things going. I mean, there's some good American companies, but most of those are really coming out of Silicon Valley. So hopefully, you know, people will have a longer term view and not be kind of beholden to to the big stock folks. Like for example, anytime you buy stock, I get things in the mail all the time. It's basically a proxy because it's not a democracy. You get basically one vote for every share outstanding. Well, my 30 shares of whatever is not really going to impress anybody when they got, a million shares outstanding. So they send me a thing in the mail saying, do you want to sign your shares over to somebody? And because my shares are so insignificant, I don't even return the mail. But by law, they got to send it out to me. But anyway, for big stockholders, a big pension plan or big mutual fund company, they can drive some of those things because they have an equity position, a large enough equity position to make a difference.
PETA just got an equity position in Levi Jeans.
Who did this?
PETA.
Oh, PETA did. And what do they want to do?
They want them to stop using leather patches on their high-end stuff.
So
yeah. They get a seat at the boardroom, that doesn't mean that's one vote.
Yeah.
Like 20 people there.
But they'll probably get their way. I mean, if you can just appease those people by taking off the leather patch and calling it good. But yeah, Levi's too is an unusual. I mean, they're based in San Francisco, so they're going to be. Bechtel was based in. Bechtel used to be kind of a household name. They do big things. There is no money to be made in being a big publicly known company, especially when you're working out of San Francisco, because it's social media will eat you alive. So yeah, but again, we got in this discussion last time, and I did make a student pretty angry because I kind of wrote off because you can, like, let's say under mutual funds, you can go and I don't mean to scare anybody with this formula. Don't worry about it. We're not going to be dealing with that kind of, well, what happened, that kind of stuff. We should pop right back up. Anyway, in my mind, there are mutual funds out there. If you want to invest in a mutual fund that invests exclusively in, sub-Saharan Africa, there's one out there. There's, little parts of Asia, India. I mean, you can find ones that invest in whatever. It's all marketing. You can find, and so a certain class of those are socially responsible ones that only invest in things that they judge are good for the environment. But sometimes, you have to do your own research, and you have to see if that is your goal. Are these guys? Does that really marry up with what they're talking about, or is it kind of marketing hype? I mean, my daughter drives a Subaru. I like Subarus, but they're not, friendly to the planet. No car's friendly. They're not sentient beings. It's a freaking car, And what kills me with her car is, that says P0 on the back, practically zero. Like, practically zero is a scientific term. It's either friggin' zero or it's not, Or the big buses when we're at Park City, all electric, zero emissions. Yeah, except for the friggin' power plant that charges you up every night. By the way, your battery, what are we going to do with that toxic waste lump here in a while? I mean, some of this stuff is, if they're fair with it, I don't have a problem. But if it's kind of short-sighted. So anyway, measuring return on investment. Yeah, it doesn't need to be this complex. I mean, they try to complex it up with a formula here. But, I mean, R obviously equals return. PT, P sub T, price when sold. So basically all they're saying here is buy high, sell low. Or no. Exactly the opposite. Buy low, sell high. But anyway, what you need to do, you do this in your head without worrying so much about these fractions. And then if you're getting a dividend, well, the dividend figures into it. So a quick example, let's say you buy this, stock for $20 and you sell it for $30. How much money did you make? You make $10 per share. How long did you have it? Say a year. And they're paying a 5% dividend. So then you figure out that 5% dividend and you add that onto the capital gain. If it was not a dividend paying stock, if it wasn't an income stock, it'd just be the capital appreciation. Or if it was just an income stock and it didn't really appreciate. Anyway, it all is fairly easy. It's not as complex as they make it look. I tell you again, though, what is kind of key on these things is that 1 year versus less than a year factor, because the tax rates are basically kind of sort of double. Most people, you figure, end up being at a 28% marginal tax rate, and that is the rate you will pay if you keep it for less than a year. It will be taxed as normal income. If you keep it greater than a year, it will typically be taxed as investment at 15%. So could be a huge difference to you. And again, I'm one slide ahead of myself. So did that all make sense to you guys? Interest payments and coupon payments. Coupons are, it's just kind of vernacular for what they talk about when they're talking about bonds. Ordinary income. So again, this could vary, it could have no effect. If you're a low income kind of person, very low, down in a 10% range, you might want to sell in less than a year. If you're a super high wealth individual and getting clobbered, you definitely want to hold it more than a year. So it depends on your situation. And just another example. So they're showing 15%. They're showing short term at 35. Again, this person's a higher wealth kind of person. I'm not assessing that, for the average guy, you're up in that 35 rate. So again, when somebody says I made 10% on the stock, did you have it exactly a year? Because that way you'd be comparing apples to apples. Your annual percentage rate would be 10%. But if you had it 5 years and it went up by 10%, it's not nearly as impressive when you annualize it. Standard deviation. So margins and risk. We'll talk about a couple things. In terms of the most common thing that we talk about when we talk about stock volatility. So there's things out there that you may or may not be familiar with in terms of stock exchanges and things like that. When people say, hey, how's the market doing today? It's just kind of a gross generalization, because the stock market's made up of a bunch of different companies, right? And so it's kind of a meaningless term to say, how's the market doing today? What most people mean when they say that is how is the Dow Jones Industrials doing today? Because that's an often cited index. Well, there's nothing special about the Dow Jones, but it does kind of overcome this problem of being able to generally say how the stock market is doing. So all they've done is lump a bunch of companies together. They make them part of the Dow. It'll have all these different companies, and for simplicity, we call that the Dow. It doesn't mean any of those companies in there are super special. It just means that all those companies should kind of go up and down and it should balance each other's out, and you should be able to say the market's trading for 25,000 or 26,000, and people have a rough idea, or the Dow is down by 800 points. People know that, hey, probably all the stocks are moving that way. But there will be exceptions, contrarian kind of stocks. And then there's other indices. There's the Standard & Poor's and other things. So one popular measure of volatility is what we call beta, right? So let's say, you're in a boat and the tide's going up and down, and you want to know kind of the height of something compared to that boat that's going up and down in the tide. An absolute comparison, to the coastline is not very valid, because everything's going up and down. So what they do in this case, that's helpful, maybe not, but what beta means is the movement of the S&P 500, Standard & Poor's 500. So just another stock index that's often used. So when the Standard & Poor's goes up and down with this kind of fluctuation, some sort of cyclical movement, by definition of beta, that is 1. Okay, the movement, the volatility of the Standard & Poor's 500 is 1. Now, if something, Standard & Poor's is going gently up and down, and this other thing's going up and down wildly, that's going to be a high beta stock. That is going to be something that's very volatile as compared to the Standard & Poor's 500. If it's a low volatility stock, the beta is going to be, say 0.2 or something like that. And it means that it's only going to be like 1/5 as volatile as the Standard & Poor's. So again, there's no real magic to these things. It's just they need something. They need some sort of yardstick out there, so they come up with sort of these artificial measurements. Then bond ratings. Bond ratings, again, you get these people who again, third-party kind of folks who assess the financial strength of the companies that are issuing bonds. And there's huge grade inflation, AAA and stuff like that. You get down to C's and D's, and you're going, oh, those are, and again, it depends who's selling it to you. If they're selling it to you, they'll say, well, that's a high yield bond. Well, if they're, judging it, it's a junk bond, which, again, nobody would want to buy a junk bond, but a high yield bond, I might buy stupidly. So keep in mind, if I'm a company and I've got great financial strength and the bonds are being issued at, say, 3%, you could probably issue yours at 2% because it involves very little risk compared to these other ones. Whereas if you're issuing a bond at like 8 or 12% or something like that, it's because you have to, because nobody wants your stuff, and it takes that kind of incentive. It takes a high return in order to incentivize people to even touch that junk. So risk and return. So again, there's no free lunch. Now, what can happen though is things can get distorted. You can be in some sort of again, getting back to the housing market where people had fooled themselves. They got in these collateralized debt obligations, and they got in all these other. What they did was they got little pieces of crap, and they put it in a bigger pile of crap. And to you and I mean, if they wouldn't have used collateralized debt obligations, if they would have called them for what they were, people would have gone, no, that's not any better. That's just a bigger pile. But no, they said, no, these are, number one, these are backed by, people in their homes, and they're not going to get foreclosed upon. They're going to pay that rent and stuff. What they didn't really say, and again, if you watch that movie, The Big Short, they'll kind of go into this. Some of these people had 5 mortgages out there. I mean, these were sketchy things, and just because you amalgamate and you aggregate them together, and they're saying that reduced the risk, it really didn't do it in that case. And so what happened in that case, they were sold as a pseudo-safe investment, when in actuality they were high risk. So that's distortion. But what you do want, and what I will willingly accept, and you should probably accept it to a certain extent when you're young, is a higher risk for a higher return. There's extremes, and you don't want to be out on either one, but having everything in cash and having everything in junk bonds is, neither one of those extremes are right. But as you go through life, you should start out on the more aggressive standpoint and transition to the least aggressive as you get super old. But anyway, that's it. So risk in terms of stocks, small firms tend to have higher growth potential but higher risk. IPOs offer high return. IPOs, again, I don't even like talking about IPOs because we can't often get into the IPOs until they are kind of inflated a bit. So it's just, like I said, you've got to know somebody. You've got to be a pretty big financial player to get in on the start of an IPO. Risk and trade-off amongst bonds. So, yep, large, well-known firms, but there's been a lot of those that are just kind of dinosaurs, and they go down. And high-risk bonds offer higher payments because they have to. Nobody would buy it regardless or otherwise. Now, mutual funds, you can get mutual funds with whatever. They can be set up however they want. Like I mentioned, they can be set up geographically. They can be set up by sectors. They can be set up, they can do this thing, they'll call them life cycle funds. And you'll pick this life cycle fund, say, like cycle 2055. And what it will do is it will start out with this risky stuff, riskier, and then if you're the 2055 part of it means your retirement date is 2055, and so as it goes through the course, over this whatever, that number of years, 25 years or so, it is going to kind of migrate from higher risk to lower risk. And by the time you get in retirement, it's going to be, primarily income stocks. It can do it anyway. But there are some common definitions, some things like, say, for example, legally, there's a thing called a international fund. Okay, so if you read the prospectus on that, and there's a thing called a prospectus. Anytime you want to invest in a mutual fund, you've got to acknowledge that you've read it. It's kind of like an end user license agreement, but like on a computer. But again, this one you should probably read rather than just fast forward through. But anyway, an international fund, by definition, must invest in companies outside of the United States. It's international. If you say, well, yeah, I've got one of those. I've got a global fund. No, global funds are slightly different in the fact that they can invest anywhere, to include the United States. So anyway, I don't see any real need to tie my investment, because these kind of are the rules of the game for this guy. And if he sees a great opportunity, domestically in a U.S. stock, but oh no, I'm an international fund, I can't invest in that. I don't want those kind of rules. But you can pick ones, defense sectors. You can go medical. You can go eco-friendly ones, or what they judge as socially responsible. The sky's the limit. There are more mutual funds than there are underlying companies. I mean, there's and it's just a weird amalgamation. So to say that mutual funds are good or bad or risky or not depends which one we're talking about. So that's why, again, if you wanted, if you're serious about investing in mutual funds, there's a company called Morningstar is one of them that provides evaluations and recommendations and ratings and things like that. Now, there'll always be biased on, looking backwards, which is unfortunate. You're going to want to get the one that's had these great returns, last year. Well, is it going to repeat that performance? Anytime you're buying stocks or mutual funds, you want to look at future performance. You're not so concerned about what's going on exactly right now. It's what is their potential for expansion, for growth. It's a forecast. That's what their price should be based upon. Real estate investments, yeah, I've never had a problem with renters. I've been extremely lucky. But then again, I'm not really a slumlord. I think if you get yourself into that situation, the renters I have they're not in weird situations. They're my renters in Germany, or they're moving around, and so although they've been there, I think 11 years now, which is fantastic for me. But anyway, there's a logical reason why it wasn't because they were in bad financial shape was the reason they were renting. I mean, they could afford to buy if they wanted to, but they just weren't decisive enough. And then the other renters I've got, they are, again, in excellent financial shape, but they may get a job offer at any time, and, they don't want to be tied down. So anyway, it all works. So what you don't want is you don't want troubles. So anyway, different types of investments. So yeah, things that suit your personal investment. I would kind of caution you from getting too involved in collectibles and some of those things, because again, sometimes those things aren't as liquid as you would think. I had friends who, I was in the Middle East, all over in Turkey, and people were buying Iranian carpets and all this other stuff. And,
Selling it on the way back.
Yeah, no. I actually did that. I had a good friend of mine, a Turkish guy, who owned a carpet store. And, I was good friends with him and his family. We'd go down to his house and stuff. And he loaned me a carpet one time because I was flying back to New Jersey, and I took it in there. And, sure enough, it would, it was worth about $300 for me, but it'd sell for about $2,000 in the States. So I took it back to this place in New Jersey and went to this place. Sure enough, there's the same carpet, $3,000 or $2,000, whatever it was. And I said, oh, well, I've got one here. Do you want to buy it? He goes, yeah, I'll give you about $300. I mean, seriously, because the guy is running a store. He's got 1,000 carpets there. What am I going to do with my one little carpet? Am I going to put it on Craigslist or eBay? Nobody's going to give me full retail for it. Why would they? They could go to a regular shop if they want to pay full price. So and then the other problem is the fakes, and that you have to be very, very knowledgeable. I've bought more fake stones and everything was fake. Even the machine-made carpets passed off as. I mean, most people were smart enough not to do it, but it's just I don't want any part of it. Okay, diamonds, things like that, controlled by one family, De Beers. It's completely a cartel. If they decided to flood the market, your investment would be signed. It's just a lot of those non-traditional investments just scare me. Learning from mistakes, have realistic goals. Borrow money to invest, except in real estate would be a problem. Taking risks to recover, yeah, this is the casino, the double up to catch up. Don't do that. So that's that part of it. The personal finance, the term project, we're going to talk about that. I'll save like 10 or 15 minutes in, and we're going to run through that again. But I want to jump to some of the new stuff. And again, it might even get a little repetitive here because we're going to be kind of diving in a little deeper into stocks. And then we'll take a break here in a bit, but just a few more minutes. So investing in stocks, the stock exchanges. So like I say, things are sold in the secondary market. Very rarely do you actually buy from the company. So do I care which exchange it's sold on? Not really. Most of the stuff I buy is actually traded on the NASDAQ, which isn't actually an exchange. It's just an electronic thing that's out there in the ether. But some of the big companies, there's prestige to trade on the stock exchange. But these guys it's kind of a dying breed. But they're still, it's historic and the rest of that. There's stock exchanges all over the world, but the New York Stock Exchange is obviously the bigger. Yep, specialists. So there's got to be some people out there that are actually just kind of market makers that are looking for the good deals, and then there's others that are representative of institutions. And then the brokerage firms will have people out there, but it's so much of it has got electronic, where the real money now is in the real estate, because of even though the speed of electricity, the speed of light is as fast as it is, for some of these computer executed trades, being a few feet closer to the mainframe that's where they're making some of the money. It's amazing because so much of it is traded electronically. And I bought 3 sets of stock last Thursday, and every one of them, before you can refresh the screen, it's executed, it's done. It's just done electronically, and there's nobody in a pit with his hand up or any of that kind of stuff. That's kind of romantic. Some of the other stock exchanges, yeah, they're around. There is the Chicago Board of Trade too, which does more like pork bellies and some of the commodity stuff, which is kind of interesting. But again, speculative stuff. There's lots of reasons to do futures and options and stuff like that, and I'll talk a little bit about it later, but most of it gets to be speculative. So OTC, over-the-counter type stuff, and the less stringent requirements than New York Stock Exchange, that certainly can be, but some of the biggest companies are still outside of New York Stock Exchange. That wasn't true 30 years ago. So now what I'm not recommending doing, and again, you kind of see this on The Wolf of Wall Street, is did you guys ever watch that movie? Not bad. A lot of, whatever. If a language offends you and other stuff like that offends you, you probably, there's tons of offensive things in it to get right down to it. I'm thinking, that kind of ticks all the blocks. But what this guy was involved in, and kind of true to form, he was involved in these unlisted stocks. So the Securities and Exchange Commission, the SEC, does kind of have some control over some of these larger companies, ones that are listed with the Securities and Exchange Commission. And so, for example, if you are in a position with a publicly traded company and you come out and just start spouting whatever, like our little friend from Tesla, Elon Musk, where he goes on Joe Rogan and gets all wasted and starts making comments, you can find yourself in jail, because you can you are in a position of responsibility. You can affect people in their trading, and you know, when you sign off, there's certain reports you sign off on that you are, you know, it's an offense. It's a perjury like thing if you're lying. Yeah. So for example, not that well, I do have some Apple stuff, but Apple a lot of times right after the first year will just get clobbered, you know, in the kind of the stock market, but also in the public opinion. And why that happens is because they say, oh, this is it. Apple's losing their dominant position. They're going down. And what that's really based upon is Apple does their reports, I think in February or so. And so it's this kind of this confluence of events. They'll say Apple, you know, just came off the fourth quarter where they had these great sales because it was Christmas time, and they, you know, do sell a lot of stuff in retail. And now this first quarter they're just doing awfully because it's not Christmas time, right? And then Apple just sits there and doesn't say anything back because they can't. They're within 30 days of their filing, so they can't make public comments on their stock. So they just sit there like a pincushion and take all this. And then the stock price drives down a little bit. And it just happens every year because it's a publicly traded company. And round about January, February, they'll say it's the end of Apple. It happens every year. And it's just a kind of a game that's played. Anyway, with other companies that are not publicly traded, and that's what the Wolf of Wall Street is about. They had these, pink sheet stocks or whatever. They're stocks that are like penny stocks. Don't do that. Don't do penny stocks. And don't go, you know, off of these bulletin board things that are traded on the internet. Because what will happen is it's called pump and dump. What will happen is they come up with some silly stock and it'll have a huge split. Like you buy it for, say, well, it's listed for 2 cents or something, but you got to pay like 4 for it. So I mean the rate on it, the split is almost double. Anyway, but you're saying, oh, it's a penny stock and it's going up by a whole bunch, and now it's at, you know, it's at 10 cents, and now it's at 20 cents and 30 cents, and it's going through the roof. And you look online and there's all these people, oh, this is it, it's going for everything. And then what the smart money does, this guy who's built this bubble, when it gets to 30 cents, he sells everything he's got, and he goes off to the next thing. And everybody who invested in it, their stuff just drops to nothing. And then it's just a pump and dump. He pumps the stock price up, and then he dumps it. And the SEC is like, that's not a listed company. It's not our problem. And that's why it's done in these high-pressure sales calls. And anyway, the movie can illustrate it better than I can. There's a lot of, again, offensive things in the movie, but the pump and dump thing that he's talking about, you will see this Jordan Belfry, I guess it is. Anyway, he does it over and over again, and that's how unscrupulous guys get by, because they don't have any SEC oversight. So that's why to stay away from penny stocks. You want a stock that's listed on an exchange, not delisted. Companies that are about to fail, I've had that happen too. Just as they're about to go out of business, they get delisted, and you're like, I'm done here. And you can write it to the bottom, or you can sell right then, but it really doesn't make a difference because it's the company's going out of business. So, after hours trading, other things going on. They are trying to modernize things. They're trying to shorten the what they call the settling time. You know, it used to be like 3 days or so between when you sold a stock and when the money was available, which is completely ridiculous. It's all done electronically now. There shouldn't be that waiting time. It's just greedy bankers in the middle wanting to have access to your money for a couple extra days. Quotations. So these guys and their quotations and some of this other stuff are kind of out to lunch. I mean, this is how it used to be, but this is not how you do it anymore. This tabular data, now you use interactive graphs, and it's very, very powerful. So I'll show you how that's done. But if you're looking in a newspaper and you're trading stocks, you are, you know, you're like the Barney Rubble of the whatever. You're using fax machines. You're getting your lunch eaten by somebody who's not as slow, somebody who has adapted. Brokers, not a big fan of brokers, and especially their recommendations. I did at one point, and this was years ago. You know, I was in the Middle East, didn't have access to information. I had a broker helping me out, and he helped himself out quite a bit. And that's a pretty common case. I mean, he didn't take much money, but he came up with stock recommendations, and then, you know,
Like, yeah, because they for a short period of time there was a law that said that they had to identify whether or not they were going to work for you or they were going to work for themselves.
yeah.
You take your money and also help you as they help themselves, but now that's optional again.
Yeah, it's called a fiduciary.
Yeah.
What you want is somebody who's a fiduciary, somebody whose interest is yours, not somebody who's wanting to generate commission, so they want to buy and sell all the time, and they're selling a position of a company that they hold. So what happened in at least 3 of these cases was, sure enough, about 6 months after the fact, I get a letter, asking me to join a class action lawsuit because, Payne Weber or whatever they were misrepresented, and they actually did not disclose that they had a position with that corporation, that they were pumping the stock for it. It's completely unethical. So that's why again, these people were not incentivized to help me. They didn't have a fiduciary relationship with me. They were self-serving. So anyway, you again need to go to third-party type things. And if you use the method I was telling you before, where you make sure it's a logical thing, something that's useful, whatever it is, a little something about the company, again, like for me, investing in Lululemon, it's kind of a no-brainer. Everybody had the stuff, right? You see the bags all over. I'm not a Lululemon. I guess they make men's stuff, but I'm not that comfortable with my masculinity to do that. I'll spare you all that. So anyway, and then it came out as a stock pick on one of the subscription sites that I subscribe to. So they make their money from subscriptions, not from giving bad advice. And then number 2, you dive into the financials. And then at a certain point, the CEO or whatever he was, I guess he was actually the founder, he got a little wonky, and I decided to sell again. What's that?
He's super racist.
Is he racist too?
Oh, that's why he named it.
Oh, Lululemon. That's right. And also, when he said something about they were complaining. They had some quality issue. Yeah, that's what I saw. I'm like, dude, you're.
They were see-through when he did a downward dog.
Yeah. He's so anyway, but I guess the product is still popular. Good. Anyway, but I mean, you got to use your own judgment, and so there's and again, it can be the best product in the world, but if the company's crap, if they've got cash flow problems, if they have management problems, then again, you don't want it. So you need to do due diligence, and you're kind of on your own. So, but anyway, you do have assistants out there. There are folks. So brokerage skills, brokerage commissions. If you're paying more than $5 a trade, $4.95 a trade is kind of what the price is. I was paying like 60 something a trade for those guys who were giving me bad advice. So full service, I think, and another part of it too is who, you may think you're a fairly wealthy kind of person. I've got a lot of money with these guys, but unless you're like a 1%er or something, you're a very small fish, and they're taking care of their other clients. So, but again, through subscriptions and through other newsletters and stuff, you can get the information. So placing an order, dead easy. And these numbers now, the buy, sell. I'm going to go through a specific example, and I'll show you some of this stuff. But I bought 8 of something last week. They don't care. They absolutely don't care. It's all digital. The stock was trading for 220 something, and I wanted to buy in like $2,000 increments. So there's actually a little online calculator. How much do you basically want to spend? And it says 8 shares. And it kind of does the reverse math, and it's just so easy, and it's so fluid because it's all done online. Now this is still cool stuff, and it still exists, and it's even more enhanced electronically. So what I was doing last week, I was kind of sensing the market movement, but more importantly, I didn't have a strong feeling either way, so I just did what they call a market order. And that means submit the order right now and buy at the price that stock is being sold for. So, it'll say the quote will come up, and again, they used to charge big money for having instant quotes. Now, most quotes, you can get instant quotes for nothing, which means there's no time delay. They used to, for a fee, they would give you instant quotes, but that paywall's kind of been broken down now. So let's say you're going to buy a stock, it's traded for $31. You hit buy or whatever it is, buy or sell, whatever you're going to do, and it executes right then. And it'll probably be something close to $31 because it's almost instantaneous. But it's going to go out there and it's going to be the next one filled. So it could vary a little bit. And that's a market order. Now, what you can do if you've got a life and you know that the thing's kind of rocking around and you see it going from 30 to 34 and then back down to 30 and you're like, it's just kind of swinging around in there and it's at 34 right now. You go, I think it's for some reason I have, some inkling that it's going to dump back down to 30. I'll put in a limit order. I'll say buy at 30, and if the stock marches up, if it goes to 35, 36, 37, the train kind of left the station. My order never got executed. But if it dips back down to 30, the minute it hits 30, boom, it gets executed. So that's a limit order. And there's another thing on there. Typically, I always put GTC, which means good till canceled, but you can put, close of business. You can put 2 weeks out where I'm going to, not execute this thing, whatever. I usually leave it open. So I've got some Under Armour stock that I'm not a big fan of, and it's trading down around 20 or something, and I bought it for 24, and I just want to be done with it. So I've got a sell order in for $24, and so I don't have to fret over it, and it's good until canceled, and at some point it's going to hit there, and boom, it'll be done. I had the same thing. Do you guys it sounds like you guys a little bit into yoga. Do you know a company called MindBody? Okay, so MindBody, good company from San Luis Obispo, where I went to school and stuff. So I jumped in on that, and it was doing the same thing, waffling. And I put in a sell order just to get me out when it got back up to the price. So boom, it did that. And I'm like, oh, where'd that money come from? Oh, it's executed. You just see it. I didn't do it on my daughter's account, and it friggin' zoomed right through. And now she's making all kinds of money, and I'm not, because I guessed wrong. It was still a good company, and it's doing well. So it can be a good, bad thing. And then stop orders. This is kind of cool where, let's say, I used to do this with Twitter. I don't like Twitter. But anyway, the way it was going, it was working this range from like 30 to 50. And Kramer, the guy from one of the stock things, said the old traditional guys have a really tough time providing a meaningful valuation of that company because it doesn't really have much in the way of assets. Yeah. And so what's the stock valued at? It does not pass any Warren Buffett test. So Kramer, the mad Kramer guy, he was on there going, this makes no sense. And I'm like, you know what? I know what he's talking about, but I think that's why I want to buy it. And I didn't take a huge position, but it's going between 30 and 50. And so what I do is when it dumped down to 30, I would buy, and I'd write it up. And when it got around 50, because I just saw it going back and forth between this range, I'd sell. And I did that 3 times. And then finally it went down to 22. And then next time it got to 30, I sold again. I said, okay, this game is over. It's not going through the predictable range that it once was. But for a while there, I probably did it 5 or 6 times. It was good. But anyway, the mechanism for doing those trades, though, is when it got to 30, I would buy. And when it got to like 35 or maybe 37, I'd put in a stop order. And what I did was I actually did a trailing stop. So when it gets to, say, 35 and it's on a positive vector, or 37 in this case, I put in a stop order for 35, meaning that if the stock fluctuates and it drops down to 35, my shares are automatically sold. If it marches away, if it goes up to 40, then I move my trailing stop up to, say, 37. And this way, I'm not going to get stopped out of the market. If it falls all the way back down to 30, well, when it hits that floor of my trailing stop, I'm out, and I watch it go all the way back down to 30, and then I buy again. You know what I mean? But that mechanism, because it would drive you nuts sitting there watching it all day. So you use a trailing stop and you sit there and you ratchet it up behind. You don't want it too close behind because there'll be some normal fluctuations. And you don't want to, it's kind of like a thermostat or something. You don't want a thermostat to, kick on and off every time the room temperature changes by half a degree. You want a 3 or 4 degree tolerance so it's not, executing all the time. And anyway, so it's a pretty powerful way of doing it. And this is available to anybody. This is all, it's on the drop down menu when you're buying stock. So stop orders, execute when stock price reaches a specific level, or you can do you can say, hey, when it gets to 50, I want to sell, so it kind of reaches up there. It's like a roller coaster, when it finally gets up there, but it's a guessing game. It's fun, but again, we're getting into speculation. But placing orders online, again, low commissions, again, $5 it's just incidental. It used to be, one of the other calculations when you're talking about how much money did I make on the stock? How much money did I pay in commission to buy it? How much money did I pay in commission to sell it? When the commissions are under $10 buying and selling, $10 total, it's not even, really worth worrying about. So buying stock on margin, I kind of killed that, Here they're talking about the Federal Reserve limits it at 50%. So these guys by law are going to call you and they're going to say, you got to meet your margin. We're going to get in trouble with the feds. You either get us some more money or you're out. And then you're out. So that's the margin call. A request from the brokerage or firm investor to increase the cash in the app in order to bring it back up to the level. Because your collateral was stock in that stock price. So you're getting beat up a couple ways. Short selling stock. This will be the last thing that we'll talk about in this section and we'll move on. So with the election that happened with Trump, and again, I'm not getting political here. I'm just telling you as a spectator, I don't care who you support, whether you can support anybody you like, you can see certain things are going to happen in markets. And in my mind, Tesla, good company, good cars and stuff, but they are, at least at this point, because they're developing new products, pretty dependent upon government subsidies, right? And I figured those would probably be tapered off if Trump versus Hillary won. So, rather than just watch the politics, I wanted to try and make a little bit of money off it. So I expected if Trump won, I was going to sell short on Tesla and expecting that stock price to fall. And so what happens is I sell short. And so what this means is that there's stock out there and I'm going to buy, say, 100 shares of Tesla, but I'm not going to pay for it right now. And it's just and also what I did with this is I used an option. So options, you've got futures and you've got options. Options, you have the right, but not the responsibility. Okay, you have the option of doing it. So maybe I get a little ahead of myself. I think I really need to talk about futures really quick. Futures they sound complex, but they're not that bad. Let's say if you've got a company like, say, Alaska Airlines, and they want to sell their plane tickets a year in advance. They next spring break, they already want to sell those tickets. You go online right now and you can buy them. Well, as an airline, the fuel component is a huge part of their pricing mechanism, right? So they need to know what fuel is going to cost a year out from now. How can you know that? That's unknowable. So what they try to do is and say if you're dependent upon sugar, you're a big baker, or whatever your big commodity that you're dependent upon, what you'll typically do is trying to get yourself some price stability by selling futures. Okay, so what you do in this case, let's say jet fuel is going for, I don't know, $5 a gallon. I'm not exactly sure, but it's whatever. Let's say it's $5 a gallon, just for simplicity. You, as Alaska Airlines, say, we will buy 1 million gallons of jet fuel for March 2020 delivery
at the price of $5.10 a gallon. And you put it out on Chicago Board of Trade or whatever. I mean, you use an intermediary, a big bank. But there's people who do this. Intermediaries who do this. And somebody buys it. If they don't buy it, then you say, okay, we're going to buy it for $5.25. Anyway, you get to a certain price point where somebody with the financial pockets says, I will take you up on that bet. Basically, I will deliver your 1 million gallons of jet fuel in March 2020 for $5.25 a gallon. It's a futures contract, so they have the right and the responsibility. So if gas or jet fuel goes up to $6 a gallon, this dude is going to get clobbered because he still he's got a commitment. He's got to deliver that 1 million gallons of jet fuel, but he's only getting paid $5.25 per gallon from Alaska Airlines, and he's having to pay $6 a gallon to provide it. He's got to come up with that, tankers of fuel to do that. Now, the reason why this person would take that contract is if jet fuel stays at $5, so he's buying this stuff for $5, and he's getting paid $5.25. Alaska Airlines has a responsibility as well. They can't say, hey, it's cheaper on the open market, we're going to do it that way. No, they are locked into that price. They've got a contract. So what that enables the big companies to do is give themselves price stability, because they can now set their prices on a known quantity. And so that's how futures markets work. And so the Tesla example, what I did was I sold short. Let's take a break and I'll explain it more to you. But basically, I was the same sort of thing where I owned the stock, but I didn't have to pay for it till a future date. And I had the different ways you could do it. But let's say that the stock price was $80. I had the ability to sell that stock at the old price, even though the new price had dumped. Let's say the stock price on Tesla went down to $70. I'm still, because I had it was like $200 or something, was all the commission, or the option price was, to control that much stock. But I could sell that stock for the old price, even though in the future the new price had dropped. Does that make sense? I know selling short is complex, but again, that's it. But the problem with options and futures and all those things, it is a zero-sum game. If we all invest in a certain company and the prices go up, we all make money, and everybody can be a winner.
Saudi Arabia dumps the market for fuel.
Yeah. But in a futures contract or an options contract, it's a zero-sum game. If that guy who takes the futures contract makes a ton of money, then Alaska Airlines lost that same quantity of money. And the same is true. Not everybody's going to be a winner. There's going to be exact, opposites on each side of the trade. But if it's attractive enough, and the way you make it more attractive is by setting that price. So it's complex, but it's interesting. But I kind of feel like I'm doing a disservice to it. But I'll show you some more examples, and maybe we'll look at an example that's with some graphics and stuff, because it's all kind of hard to just explain in words. Anyway, let's take a quick break. We'll come back in and we'll reattack this stuff.